All right, so today we are going over some actual old test questions that I've put on a finance test. So basically, you might be asking the question like, okay, well, what does a test look like that has capital budgeting, NPV, IRR type of questions? And today, what we're going to do is go over some of this stuff. And you're going to find out that what I'm going to do is actually show you the exact test questions that I had one semester ago. And I'm going to go over with you to how to solve them and how to actually go through a compute step by step. I think this is going to be a really big help to anybody out there watching who, is in some basic, business finance, financial management type of class that is having trouble with the calculations, because this is going to be a great kind of check with me thing. Because what we're going to do is show these problems one at a time and then go over the solutions. So what you're going to end up seeing is how you solve these problems step by step by step, so that when you start working the problems on your own, whether it be a quiz, homework, a test, that you can feel a little bit more confident in how to work the problems. And you'll have a much better idea of what exactly that we're doing in a situation like this. So what I'm going to do is go ahead and get to the questions now. So on the test, the big thing to remember from these problems that are involving capital budgeting is that they're mostly problems. So the thing is, what you want to do, as opposed to the first couple of tests, which are, more conceptual and definitional type questions than actual problems, what you want to do is go here and look through these and see exactly, okay, what does this problem entail as far as, what calculations do I need to do? What formulas do I need to know? And so the formulas you need to know for this particular problem set are the CAPM formula, which is the risk-free rate plus beta times the return on the market minus the risk-free rate, and the weighted average cost of capital formula. So what I do with the weighted average cost of capital formula, I go ahead and give you exactly what the weights are and don't make you compute the weights in this particular variation. Now, if you get to a more advanced finance class, you will have to go through and compute those weights and do stuff like this. But what we're trying to do, because this is an introductory type of problem, is we want this to be as simple as possible so you can understand the concept and understand a little bit about what you're doing before we move to anything that's crazy advanced. So the last thing in doing these problems is to remember the rules of PEMDAS, or it can even be called "Please Excuse My Dear Aunt Sally." So if you remember, what you're doing is you're doing what's in the parentheses first, then you multiply, then divide, then add. So as long as you remember to do it in that order, parentheses, multiply, add, then you're going to get the problem right. And almost always, if you get a CAPM or WACC problem wrong, it's because you did not follow the rules of PEMDAS. Or "Please excuse my dear Aunt Sally." I kind of like "Please excuse my dear Aunt Sally" a little bit better. It kind of sounds a little more personable than PEMDAS. I mean, PEMDAS just sounds like a computer program gone bad or something. I'm not even sure what that's about. So this is the first problem from last semester's test. And this is a CAPM problem. And what you'll see in this problem set is you'll see the same verbiage repeat for 7 problems. But the question at the very end of the problem will tell you exactly what you're looking for. So in this problem, what I always did in school, and someone had told me this way back when, and it always has been like crazy successful for me. And it's always been something that I have done when taking a test, is I work backwards. So what I like to do is I like to go to the very bottom where it says, what is CAPM? And when I see that, what is CAPM, then I know that, okay, well, that's what I'm looking for in the problem. So if I know I'm looking for CAPM, what I'm specifically looking for in this problem is, what is the risk-free rate? What is the return on market? and what is the beta. So those are the three things, because keep in mind, the CAPM formula is only three factors. And so those being the only three factors are the only three factors that you're going to look for in a CAPM problem. So what you want to do in the CAPM problem is, again, go through this and read it, but be looking for the market return, the risk-free rate, and the beta. So a company is considering expansion into a new market. This will cost 1.5 million. The company estimates the project will have a beta of 1.1. Okay, that's the first thing we need. Second thing, the return on market is 10% and the risk-free rate is 3%. All right, we just got everything we need in order to compute CAPM. We don't have to worry about the rest of the problem because, again, those numbers are in there to solve other problems, but not the CAPM. So we got the three numbers that we're looking for. The beta is 1.1. The return on market is 10%. The risk-free rate is 3%. So let's go ahead and solve this out and see exactly how this would work. So when we solve this using the CAPM formula, how I have it laid out is step 1, step 2, and then step 3. So what you see in step 1 is the very first thing we do is follow the please excuse my dear Aunt Sally. We do what's in the parentheses first. So the very first thing we do is take the 10%, the return on the market, minus the risk-free rate of 3%, and we make that 7%. So that is the very first thing we do. So you see in step 2 of the problem, what we do is we then multiply, because keep in mind, PEMDAS, parentheses, then multiply, then add. So what we do is we multiply the 1.1 times 7%, and that gives us 7.7%. Then the final step is we add those together. 3% plus 7.7% equals 10.7%. So keep this handy. And when you keep this handy, because we are going to use this in further problems. So the answer in this case is 10.7%. And again, if you did not get it right, the primary reason that you did not get it right is you did not follow the rules of PEMDAS. And that is what you are wanting to do. Parentheses, multiply, then add. And just remember that going into a test. As long as you remember that, you're going to have a really, really successful outcome with these types of questions. So let's go on to the second question. Weighted average cost of capital. So the weighted average cost of capital is the cost of equity that's weighted plus the cost of debt that's weighted. So what we're looking for here is what is the weight of debt? What is the weight of equity? What is the cost of debt? What is the cost of equity? And then the tax rate. So what we're doing in this problem is we're going to read through looking for those four things: weighted debt, cost of debt, weight of equity, cost of equity, and then the tax rate. So a company is considering expansion into a new market. This will cost 1.5 million. The company estimates the project will have a beta of 1.1, return on market is 10%, and the risk-free rate is 3%. We know those don't matter for WACC. Those mattered for CAPM. They do not matter for WACC. So the next part is what matters for WACC. The weight of debt is 50%. So if the weight of debt is 50%, then the weight of equity must be what? Because, hey, it's not given in the problem. So if the weight of debt is 50%, then the weight of equity would also have to be 50% because they have to equal 100%. The weight of debt and the weight of equity has to equal 100%, unless you also have like a little bit more advanced problems where you have preferred stock involved. So, and then you'd have weight of preferred stock in there also that would have those three would have to equal 100%. But again, this is just an entry level question. And so if the weight of debt is 50%, the weight of equity has to be 50%. Cost of equity is 4%. Cost of debt is 5%. So the tax rate is 40%. So that is the information we need to use to solve WACC. Now, the cash flows that are in this problem, we don't need those until we start to compute our NPV and IRR type of problems. And so what we're going to do in this case is go through and set up WACC and solve it. So what we're doing is we take the weight of equity, 0.5, times the cost of equity, 0.04. And then we add to that the weight of debt, 0.5, times the cost of debt, 0.05, times 1 minus the tax rate. So in this case, it's 1 minus 0.4. So keep in mind, just like the CAPM problem, what we're doing in this problem is doing what is in the parentheses first. So the very first thing you do is do what's in the parentheses. So you look at step 2 of the problem. That's the only thing that's done is 1 minus 0.4, which gives us 0.6. So then what we need to do is multiply both of these sides together. We do 0.5 times 0.04. That gives us 0.02. And then on the other side of the equation, we do 0.5 times 0.05 times 0.6, which is 0.5 times 0.3, which gives us 0.015. So then our answer is 0.035 or 3.5%. So that is your WACC for the problem. So I intentionally did this in a decimal version, whereas I did CAPM in a percentage version. And I did that intentionally to show you that, hey, you could do it either way. If you want to do it decimatized and then convert it back to a percentage, no worries, you can do that. If you want to do it as a straight percentage and just do it that way and you find it easier to do that way, then you're more than welcome to do it that way because you're going to arrive at the same mathematical answer either way. I just wanted to demonstrate both methods because I know people have their preferences and certain things they like to do, but this gives you a way that you can, hey, do what's comfortable for you. A lot of these problems that we work, there are multiple ways to arrive at the correct mathematical solution. And again, me and pretty much any professor is going to be okay if you're getting the right answer as long as your process is correct. And that's the main thing. As long as your process is correct, as long as you're following the steps of PEMDAS, then you're going to be able to go in there and really do some good work. So in the next part of this, what we're going to do is go in and going to go do some other things in regards to the capital budgeting, figuring out NPVs and WACC. So this is the exact problem that is on the test that uses this. So if you remember from like homework or your basically intro problem, with NPV, what you're doing is a lot of times with the intro problems, they're giving you the interest rate. And this is one that's more of an intermediate level NPV problem, but also something that's very easy to try to get a hold of. So what we do in this case is we've got the problem that we've already gone over. You've got a company that is considering expansion to a new market. It's going to cost 1.5 million. So we've already figured out what our CAPM is, 10.7%. So what we're going to do now is figure out what NPV is. So on the financial calculator, if you go over and hit the CF button, you will see cash flows. Now, this is very, 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 very important to do. So you see that I already have cash flows entered in this calculator. So what you want to do is you want to hit second and then clear. That clears everything out of there. So that's very important because, like, say, in this problem, we have 5 years worth of cash flows. Well, let's say in the previous problem, we had 10 years of cash flows. Well, guess what happens to those cash flows from years 6 through 10 if you don't go in and do the all clear? Well, they show up in there and those cash flows are in there. And then your answer is going to be totally messed up. And with a totally messed up answer, you're going to be wondering, hey, what did I do? I didn't do, I thought I did all the steps right, entered in the stuff right. Well, that's the one thing you didn't do was clear it out. So huge thing. Make sure you hit second and clear on the TI, and that clears out all your work. And you'll be able to do a lot more things by doing it that way. And it just gives you a clean slate to start with. So CF0 is how much is this project costing us in year zero? Well, we see in the problem, the project costs 1.5 million. So we type in 1500000. So we have 1.5 million. This is also very important. Enter this in as a negative because that first cash outflow is an outflow. It's not an inflow. No project is going to yield you a positive return at T0. It just doesn't work like that. T0 is always going to be a cash outflow. So what we do after we do that, you hit enter, not the equal sign, but enter, like enter, enter, and then hit the down arrow. And then you get to C01, and C01 is 400,000. So you enter in 400,000, and then enter, and then the down arrow. So when you click the down arrow once, it says F01. F01 means the frequency of payments. So like if you're doing a monthly payment or something like that, your F01 would be 12. Or if it's semi-annual, it'd be 2. So what we're going to do is these are all just annual cash flows. So we're going to keep the F01 and the F02 and the F03 and so on at 1. We're not going to adjust it. So we're just going to hit the down arrow again. Our C02 is also 400,000. So I hit 400,000, I hit enter, and then I hit the down arrow. Again, F02, we're not going to change. And then I hit it again and go to C03. C03 is 500,000. So I hit 500,000. Then I hit enter, and then I hit the down arrow. And again, F03, we're not changing. So we hit the down arrow again, go to C04. C04, the cash flow in year 4 is 250,000. So we enter in 250,000, enter, down arrow, down arrow. C05 is 300,000. So I enter in 300,000, and then I hit enter, and then I stop after I hit enter because I'm all done entering in the cash flows at that point. So all I have to do then is go to NPV where it says I equals. Now keep in mind we're using CAPM, which was 10.7. So we put in 10.7. And when you put this in the calculator, another important thing to remember, you put the 10.7 in as a whole number. You don't have to decimalize it and put it in as 0.017. The calculator will automatically do that kind of work for you. So it's very important that you enter it as a whole number, or again, your answer will be messed up. So then I hit enter, E-N-T-E-R, and then hit the down arrow. And where it says NPV equals, right now it's showing nothing. Or if you'd previously worked an NPV problem, it would show you what the previous NPV answer is. So don't be confused, it's not the answer. NPV is not equal to that, so we would hit compute. And the answer is negative 96,739. So we have a negative answer for NPV. So if you remember in capital budgeting, the decision rule for NPV is if if your interest rate or your cost of capital is lower than your rate of return, then you would reject the project. Also, if NPV is negative, you reject. If NPV is positive, you accept. So in this case, we have a negative NPV, which means we reject the project. So let's go on and do the NPV using CAPM. And when we do the NPV using CAPM, what we have here is the same thing. Sorry, we just did NPV using CAPM. NPV using WACC. So keep in mind, if we go to the cash flows, we don't have to re-enter these in because they're the exact same. Cash flows did not change. The only thing that changed in this problem was when we hit NPV, I equals instead of 10.7, our WACC was 3.5. And then we hit enter, and then we hit the down arrow, and then compute. And our NPV using WACC is 181,301. So that's a positive NPV. So we would accept it using WACC, but we would reject it using CAPM. So now let's go over the internal rate of return. So the thing is, mathematically, how you would figure out what the IRR is would be this. IRR conceptually is the interest rate when NPV is equal to zero. So how you would figure this out by hand would be, okay, well, I think the IRR would be, say 7. Does that give us an NPV of 0 if I put in NPV equals and 7? And if it's a little high, or if you have too much of a positive NPV, then you would raise that a little bit. If it's negative, you would lower that a little bit. But it's really easy to do on the modern versions of the TI calculator. All you have to do is hit IRR and then compute. And you see in this case, our IRR is 7.95. So what is the decision rule regarding this? Well, if IRR is greater than your cost of capital, then you would accept the project because, layman's terms, you're making more interest than it's costing you. And so anytime you can do that, you would want to take on the project. However, the problem is we're using two different interest rates here that are giving us conflicting answers. So under WACC, you would be like, yeah, accept this thing. Under CAPM, where your CAPM is 10.7, you would reject it. Now, why are WACC and CAPM so different? Well, one of the main reasons is CAPM is considering risk. The WACC is just what your cost of capital is. However, that doesn't tell us what the risk of a project is because not all projects are the same. So, let's say, for instance, I'll use Walmart as an example here. If Walmart wants to open a new store in, we'll say, Columbus, Ohio, Walmart already has 6 locations in Columbus, Ohio. So if they open a 7th, they already have a really good idea of what to expect. Okay, we're opening up in a burgeoning area of town that a lot of new housing starts are going on. Population is moving there. We're going to open a new Walmart there. They have a really good idea of what their cash flows are going to look like because they have a basis of comparison. But let's say Walmart is going to open its first ever location in, we'll call it Dublin, Ireland. Well, how is the risk of Dublin, Ireland going to compare with the risk of Columbus, Ohio? It's way riskier because it's a totally different market. Walmart doesn't necessarily have all the supply chain connections in Ireland that they might have in Ohio. They don't have the cash flow estimation ability in Ireland that they would have in Ohio. And it's a lot more risky of a project. Doesn't mean it won't succeed or that it's not a good idea. But if we're doing an apples to apples comparison, it is a riskier project. So that's something you want to keep in mind. So the next thing we want to look at here is the payback period. So what the payback period means is that in the absence of interest, how long does it take you to pay back something? So in other words, a thing would be like this. You come up to me on the street and you're like, hey, can I borrow 20 bucks? And my question would be, my first question is, when am I getting this $20 back? And you say, oh, I get paid Friday. I'll give it to you Friday. Well, that's my payback period is, well, I know exactly what day I'm going to get it back and how many days it's going to take in order to pay back. And let's say it's a close friend, a family member, something like that. I'm not going to charge interest. That's what payback period means. So in this problem, what we're doing is figuring out how long does it take to pay back that initial investment of 1.5 million. So what I'm going to do is go clear it out, and I'm going to start with 1.5 million. And this is a negative, keep in mind, because that is a cash outflow. So how long is it going to be before this becomes 0? That's the question. So year 1, we make back 400,000. So I put in 400,000. So at the end of year 1, we still have not paid back 1.1 million. Year 2, we have cash flows of 400,000. So I'm going to add that 400,000. So at the end of year 2, we still owe 700,000. Year 3 is 500,000. So I'm going to add back 500,000 to that. And at the end of year 3, we still owe 200,000. So in year 4, we get cash flows of 250,000. We only owe 200,000. So we know that that payback period lies sometime between year 3 and year 4, because that's our remainder. So all we have to do is take this 200,000 and divide it by the year 4 cash flows, 250,000, and it gives us 0.8. So our answer is the payback period is 3.8 years. And that is the answer to the problem. So the final part of this problem is this: should we accept or reject this particular thing? And the answer is it's inconclusive. NPV is saying that if we're using WACC, we accept. If we're using CAPM, we reject. So it's inconclusive because we have one saying yes, one saying no. So therefore, we don't know exactly what the answer is. Now, when you get into more complicated problems, what we're going to do is weighted NPVs where we have different scenarios involved. And so in the next set of videos, that's what we're doing, is the more complicated questions where we're actually doing a little bit of a Monte Carlo analysis or a scenario analysis and showing exactly, okay, under multiple scenarios, what would be our expected NPV? And so I hope this video really clarified things for you. If you enjoy the video, please comment below, smash the like button, and everybody, good luck when studying for this, and we will be posting more.